Most people come into trading the same way I once did, with too much hurry and not enough understanding. They think the market is a place to make quick money. But the market is not a slot machine. It is a place where patience gets paid and impatience gets punished. If you want to master trading, you must first learn to think like a professional operator. Not like a gambler, not like a hopeful dreamer, but like a man who respects the tape and listens when the market speaks. I have said before, and I'll say it again. The big money is not in the buying or the selling. It is in the waiting. And that brings us to the first step. Step 1 is learning to read the market instead of predicting it. Too many traders try to outguess the market. They form opinions. They marry their forecasts. They say, it must go up, or it has to fall. But the market does not care what you think. It only cares about supply and demand. Have you ever noticed how often the market refuses to behave the way you expected? That is because the tape tells the truth, and opinions rarely do. Your job, and I mean your real job, is to study price behavior. Watch how a stock moves. Notice where it hesitates. Notice where it accelerates. Charts are simply a picture of human behavior, and human behavior does not change as much as people believe. When you learn to read that picture calmly, without excitement, you begin to see opportunities that most people miss entirely. But reading the market alone will not save you. Many traders can read charts. Very few can manage themselves. Which brings us to step 2, control your risk like your future depends on it. Because it does. In my early days, I learned this lesson the expensive way. Not because the market was unfair, but because I was careless. You see, it is not enough to be right sometimes. In trading, survival comes first. Always first. What good is a brilliant prediction if one bad trade wipes you out? Ask yourself honestly, do you protect your capital, or do you chase the thrill of being right? Every professional trader understands one simple truth: losses are part of the business. The difference between the amateur and the seasoned operator is not who loses, it is who loses small. When a trade proves you wrong, you must step aside quickly and without drama. No arguing with the market. No hoping. No praying. Just disciplined action. Keep your losses small and your mind clear. That alone will put you ahead of the majority. Now, step 3 is where patience separates the strong from the restless. Wait for the right setup. This is where most people fail, and they fail quietly. They trade too often. They feel they must always be doing something. But activity is not the same as progress. Have you ever taken a trade simply because the market was open and you felt you should be involved? That feeling, that itch, has cost traders more money than bad analysis ever did. The market only offers a few truly good opportunities at any given time. Your job is not to trade every day. Your job is to wait for moments when the odds lean clearly in your favor, when price confirms your idea, when the trend supports your position, when volume agrees with the move. Those moments do not come every hour, and they certainly do not come every day. But when they do come, and you are prepared, that is when the professional steps in quietly and confidently. Patience in trading is not passive. It is active observation. It is controlled readiness. It is the discipline to do nothing when nothing should be done. And believe me, that discipline is rarer than any chart pattern you will ever study. Step 4, and perhaps the most overlooked, is developing the right money mindset. Trading is not just numbers on a screen. It is a test of temperament. The market has a way of exposing every weakness you have: fear, greed, impatience, overconfidence. If you do not master your emotions, the market will gladly do it for you. And the tuition is never cheap. You must think in probabilities, not certainties. No single trade matters very much. What matters is your process repeated over time. Professionals know this. Amateurs forget it the moment a trade moves against them. Have you ever watched a small loss turn into a large one simply because you did not want to admit you were wrong? That is not a market problem. That is a mindset problem. Wealth in trading is built the same way strong positions are built. Carefully, patiently, and with respect for risk. There is no need for heroics. No need for dramatic bets. The steady operator who compounds gains and protects capital will, over time, outperform the excited trader who swings for the fences. Now let me tell you something many people do not like to hear. Consistency in trading is boring. It does not feel exciting to wait. It does not feel thrilling to cut losses quickly. It does not feel glamorous to sit on your hands while others are bragging about quick wins. But the market does not reward excitement. It rewards discipline. Always has. Always will. When you begin to follow these 4 steps, truly follow them, something interesting happens. The noise of the market starts to fade. You stop reacting to every tick. You stop feeling the urge to chase every move. You begin to operate with quiet confidence instead of nervous energy, and that is the point where a trader starts to separate himself from the crowd. Small losses are business expenses. Large losses are career killers. If you remember nothing else about trading, remember that. Every professional operator I have ever known learned this lesson sooner or later, usually the expensive way. You see, losses are not your enemy. They are part of the game. The market does not hand out perfect trades, and no method, no system, no chart pattern has ever produced certainty. The man who expects to be right all the time is already in trouble. But the man who knows how to lose properly, that man has a future in this business. Have you ever noticed how one careless trade can erase weeks of careful progress? In trading, the size of your loss matters far more than the frequency of it. A trader can be wrong half the time and still build steady equity, provided his losses are kept small and his winners are allowed room to grow. But one oversized loss, just one, can damage both the account and the confidence behind it. And confidence, once shaken, does not return easily. The trouble begins when traders treat small losses like personal insults. They hesitate. They argue with the tape. They tell themselves the market will come back. That kind of thinking has ruined more accounts than bad analysis ever did. The market does not reward stubbornness. It rewards discipline. When price proves you wrong, the professional steps aside without drama. He does not negotiate with the market. He listens. Think of every trade as a business transaction. When a shop owner buys inventory that does not sell, he marks it down and moves on. He does not lock the doors and pray the customers change their minds. Yet traders do this every day with losing positions. Why? Because pride is expensive, and hope is even more expensive. A small, controlled loss keeps your capital intact and your mind clear. It allows you to stay in the game long enough for the real opportunities to appear. Because they will appear. They always do. But only for the trader who is still solvent and still thinking straight. Have you ever been so deep in a losing trade that you could not even see the next good setup forming right in front of you? Large losses do more than hurt your balance. They distort your judgment. After a heavy hit, traders tend to revenge trade, overtrade, or abandon their rules entirely. They stop operating from discipline and start operating from emotion. And once emotion takes the wheel, the account usually follows the same unfortunate path. This is why position sizing and predefined exits are not optional tools. They are survival tools. Before you enter any trade, you must know exactly where you are wrong and exactly how much you are willing to pay to find out. Not after the trade moves against you. Before, the professionals decide their risk in advance. The amateurs discover it in real time, usually when it is already too late. Over time, something interesting happens when you consistently keep losses small. Your equity curve smooths out. Your confidence becomes steadier. You stop fearing individual trades because you understand no single position has the power to do serious damage. That quiet confidence, not excitement, is what allows a trader to operate clearly under pressure. Remember this well: the market will always offer another opportunity, but it will not always give you another chance if you let one trade get out of control. The difference between traders who last and traders who disappear is often nothing more complicated than how they handle being wrong on an ordinary Tuesday afternoon. High probability setups appear rarely. Wait for them. That simple truth separates the patient operator from the restless crowd. Most traders do not fail because they lack intelligence. They fail because they cannot sit still long enough for the right opportunity to present itself. The market is open every day, but true opportunity is not. Have you ever felt the urge to take a trade simply because the screen was moving and you wanted to be involved? That urge is expensive. The professional trader understands that most market movement is noise. Price wiggles, headlines flash, indicators flicker. But none of that guarantees an edge. A high probability setup has certain characteristics. The trend is clear. The structure makes sense. Volume confirms the move. Risk can be defined cleanly. When these pieces align, the odds begin to lean in your favor. Not certainty, never certainty, but favorable odds. The amateur, however, grows impatient. He tells himself, "This looks close enough." Close enough is the language of unnecessary losses. The market has a way of punishing trades that are taken out of boredom or impatience. You must learn to recognize the difference between a good-looking chart and a truly qualified setup. One tempts you. The other pays you. Waiting is not easy work. In fact, it is some of the hardest work in trading. Your mind will try to convince you that you are missing out. It will whisper that others are making money right now. But the seasoned operator knows something the crowd forgets. Money made outside your edge is money borrowed from the market, and the market has a habit of collecting its debts. Have you noticed how your worst trades often come during quiet periods when you felt the need to force something? That is no coincidence. Forced trades usually lack alignment. The trend may be unclear. The entry may be rushed. The stop may be wider than it should be. These small compromises stack up, and before long, the probabilities are no longer working in your favor. A high probability setup, on the other hand, feels almost calm when it appears. The chart looks clean. The risk is obvious. The entry makes sense without mental gymnastics. You are not hoping. You are observing and acting. There is a quiet confidence that comes from preparation meeting opportunity. But here is where many traders stumble. Even when the right setup appears, they often enter too early. They anticipate instead of confirm. They try to be first rather than be right. I learned long ago that it is better to miss the first part of a move than to be early and wrong. The market will give you plenty of chances if the move is real. Have you ever jumped in early, only to watch price shake you out before moving exactly where you expected? That is the cost of impatience. The disciplined trader waits for confirmation. He lets price prove itself. He allows the market to show its hand before committing serious capital. This does not mean hesitating forever. It means acting only when the evidence is in your favor. Over time, this selective approach changes your entire experience in the market. You trade less, but with greater clarity. You feel less emotional pressure because every trade has a clear reason behind it. Your results begin to reflect quality over quantity. The market does not pay you for being busy. It pays you for being right at the right time. And the right time does not come nearly as often as most traders would like. Trends deserve respect. Fighting them is expensive. That is not theory. That is experience speaking. The market has a way of humbling traders who believe they are smarter than the prevailing move. I have seen men with sharp analysis and good instincts lose steadily simply because they insisted on calling tops in rising markets and bottoms in falling ones. Tell me honestly, have you ever tried to pick the exact turning point just to prove you could? There is a certain temptation in counter-trend trading. It appeals to the ego. It makes a man feel clever when he thinks he has spotted the precise moment the crowd is wrong. But the market does not reward cleverness nearly as often as it rewards alignment. When a stock is moving strongly in one direction, there is usually a reason. Supply and demand are out of balance. Momentum is in motion, and momentum, once established, tends to persist longer than most traders expect. The professional operator begins with a simple question: which way is the path of least resistance? Not where the market should go, not where it feels stretched, only where the weight of money is currently pushing price. Charts make this visible if you study them calmly. Higher highs and higher lows tell one story. Lower highs and lower lows tell another. The tape is always speaking. The question is whether you are listening or arguing. Fighting the trend usually begins with small rationalizations. It's overextended. It can't keep going. It's due for a pullback. Those phrases sound reasonable, but they often hide impatience or ego. Trends can remain extended far longer than a trader can remain comfortable. Have you ever shorted a strong uptrend only to watch it climb day after day while your position slowly bleeds? That is the market's way of teaching respect. Now, respecting the trend does not mean chasing blindly. That is another mistake altogether. The disciplined trader waits for proper structure, pullbacks, consolidations, clear continuation patterns. He enters with the trend, not because it guarantees success, but because it improves the odds. Trading is a game of probabilities, and the trend is one of the few edges the market offers freely to anyone patient enough to see it. Another costly habit is assuming every strong move must reverse immediately. Markets do correct, yes. They retrace, they pause. But true reversals usually leave footprints, changes in structure, shifts in momentum, failures to make new highs or lows. The amateur tries to anticipate the turn. The seasoned operator waits for evidence. Which approach do you think protects capital better over time? When you align with the trend, something interesting happens to your trades. They tend to move more smoothly. Pullbacks are often shallower. The market does more of the heavy lifting for you. When you fight the trend, the opposite occurs. Every tick feels like work. Every move feels uncertain. You are no longer working with the market's natural flow. You are working against it. This is not about being stubbornly bullish or bearish. It is about being flexible enough to recognize what the market is actually doing right now. The trader who survives is the one who adapts quickly and without ego. Markets change, trends end, new trends begin. But the cost of standing in front of strong momentum remains consistently high. Consistency in execution beats brilliance in prediction. That may disappoint the fellow who prides himself on clever market calls, but the market has never paid steady money to the man who is only occasionally right. It pays the operator who shows up with the same discipline day after day, trade after trade, regardless of excitement or boredom. Tell me, how many traders do you know who can predict well, yet still struggle to grow their accounts? Prediction is seductive. It makes a trader feel sharp, insightful, almost prophetic. But trading profits do not come from being impressive at cocktail conversations. They come from managing risk, following rules, and repeating sound behavior over and over again. One brilliant call followed by 3 undisciplined trades leaves a man poorer than before. The professional understands this early. He builds a process and then respects it. Entry rules, exit rules, position sizing, risk limits. None of these are glamorous, but they are reliable. When the moment comes to act, he does not improvise wildly. He executes what he has already decided in calm conditions. Have you ever made a good plan before the market opened, only to abandon it the moment price started moving? That is where consistency breaks down. Markets are emotional environments. They provoke fear when price drops and greed when price runs. Without a consistent method of execution, a trader's behavior begins to change with every fluctuation. One day he is cautious. The next day he is aggressive. One trade he follows his stop. The next trade he gives it a little room. These small inconsistencies rarely feel dangerous in the moment, but over time they erode both capital and confidence. Consistency creates something far more valuable than occasional big wins. It creates statistical reliability. When your execution is steady, your results become measurable. You can review your trades honestly. You can refine your edge. You can identify what works and what does not. But when your behavior changes from trade to trade, the results become noisy, and the trader is left guessing instead of improving. There is another quiet advantage to consistent execution. It reduces emotional strain. When you know exactly how you will act in common situations, the market stops feeling chaotic. You are no longer reacting. You are responding according to plan. Losses feel less personal. Wins feel less intoxicating. Your equity curve may still rise and fall, but your behavior remains steady. And in this business, steady behavior is a rare and valuable asset. Brilliant predictions, on the other hand, often encourage bad habits. A trader makes one spectacular call and begins to trust his instincts more than his rules. He sizes up too quickly. He skips confirmation. He believes he sees something others do not. Sometimes he gets away with it, for a while, but the market has a long memory and very little sympathy for overconfidence. The truth is simple. Though not always easy to accept, You do not need to predict every move to build wealth in trading. You need to execute your edge faithfully and repeatedly. Small advantages applied consistently compound quietly over time. That is how serious operators grow accounts while the crowd chases the next brilliant guess. Watch any group of struggling traders closely and you will usually find the same pattern. Their analysis is often reasonable. Their chart reading is not terrible. But their execution shifts with mood, with recent wins or losses, with outside noise. They are not defeated by lack of knowledge. They are defeated by lack of consistency. And the market, patient as ever, continues to reward the trader who does the ordinary things extraordinarily well. In trading grows from disciplined repetition, not dramatic wins. That idea runs against the grain of what most newcomers believe. They arrive in the market looking for the one big trade, the home run, the lucky strike, the story they can tell. But the professionals know better. The market rarely builds fortunes in a single moment. It builds them slowly, quietly, trade by trade. Tell me, how many traders have you seen chase the big win only to give it back just as quickly? The excitement of a large gain can be dangerous. It gives the illusion that speed equals skill. A trader catches one strong move and begins to feel invincible. Position sizes creep up. Risk controls loosen. Discipline fades. What began as a good trade turns into a dangerous mindset. Because the truth is, one large win proves very little. It is repetition under control that proves whether a trader actually has an edge. Disciplined repetition means doing the same sound things over and over again, even when it feels ordinary. It means waiting for qualified setups. It means sizing positions according to plan. It means cutting losses without hesitation. None of these actions are dramatic. In fact, they are often boring. But the market has always paid steady money to the trader who respects boring discipline. Have you ever noticed how quickly inconsistent traders swing between confidence and frustration? One good trade lifts them high. One bad trade knocks them flat. Their results come in bursts because their behavior comes in bursts. But the steady operator approaches each trade with roughly the same process, the same risk awareness, the same emotional control. Over time, this steadiness compounds in ways that surprise those who are only watching for big moves. Compounding is the quiet engine behind trading wealth, not excitement, not prediction, not bravado. Small gains, protected carefully and repeated consistently, begin to stack on top of each other. Weeks turn into months, months into years, and the account grows not because of one spectacular decision, but because of many disciplined ones. This is why risk management and mindset are inseparable from wealth building. If you cannot repeat your process calmly, your results will always be uneven. If your position sizes swing wildly, your equity will swing the same way. If your emotions dictate your trades, your account will reflect emotional volatility rather than calculated growth. The market has a way of mirroring the trader's behavior with uncomfortable accuracy. Another thing the public misunderstands is the role of patience in wealth creation. Dramatic wins feel fast, but they are unreliable. Disciplined repetition feels slow, but it is durable. The operator who survives long enough with capital intact eventually encounters many favorable opportunities. The impatient trader often burns through his stake before those opportunities can fully work in his favor. You must begin to think like a business operator rather than a speculator chasing thrills. Each trade is simply one of many transactions in a long series. No single result defines the outcome. What matters is whether the process, the disciplined repetition, holds together over time. Have you built a method you can follow 50 times in a row without improvising? Because that is the real test. When traders finally understand this, something shifts in their behavior. They stop hunting for miracles. They start respecting routines. They become less concerned with catching every move and more concerned with executing cleanly when their edge appears. And slowly, sometimes so slowly it almost feels invisible, the equity curve begins to reflect the power of controlled, repeated action. The trouble is, most traders never stay patient long enough to see this effect fully unfold. The market rewards patience more than prediction. That may sound simple, but most traders spend years learning it the hard way. They come into this game believing the man with the sharpest forecast wins the money. But the market has a different habit. It pays the man who can wait longer than the next fellow. Tell me honestly, how often have you rushed into a trade because you thought you saw the move coming? Prediction has its place, of course. A trader must have a reason to act. But prediction alone is cheap. Anyone can make a bold call. The difficulty lies in waiting for the market to confirm that your idea has merit. The patient operator does not hurry his capital into uncertain situations. He watches. He observes. He lets price reveal its intentions. In my experience, most losses are born from impatience rather than poor analysis. A trader sees something forming and jumps early. He fears missing the move. He worries the opportunity will run away without him. But the market rarely rewards anxiety. It rewards timing aligned with evidence. Have you ever entered a trade too soon, only to watch the market move sideways or against you before the real move began? That is the cost of impatience. Patience in trading is not laziness. It is controlled restraint. It is the ability to sit with cash in your account and not feel compelled to act every hour the market is open. Many traders confuse activity with progress. They believe they must always be involved. But the seasoned operator understands that money is often made by waiting, sometimes for days, sometimes for weeks, until conditions are clearly favorable. The charts will always be moving. Prices will always be fluctuating. But strong, high-quality opportunities appear far less frequently than most people think. When you begin to study the market calmly, you start to notice this pattern. There are long stretches of noise, followed by brief windows of clarity. The patient trader prepares for those windows. The impatient trader exhausts himself during the noise. Another danger of over-reliance on prediction is emotional attachment. When a man becomes too proud of his forecast, he begins to defend it. He holds losing trades too long. He ignores changing market behavior. He stops listening to the tape and starts arguing with it. That is a costly habit. The market does not care how clever your original idea was. Patience keeps you flexible. When you are willing to wait for confirmation, you are also willing to admit when the market is not behaving as expected. You stay objective. You stay observant. Your capital remains available for the moments that truly matter. Have you noticed how much clearer the market looks when you are not already committed to a position? There is also a financial advantage to patience that many overlook. Fewer trades often mean lower costs, not just commissions, but emotional wear and tear. Every unnecessary trade drains attention and confidence. Over time, this quiet erosion can be more damaging than a single obvious mistake. The trader who waits selectively preserves both capital and clarity. The market has been around far longer than any of us, and it has a long memory. It consistently transfers money from the impatient to the patient. Not in one dramatic sweep, but gradually through repeated small decisions. Those who learn to sit quietly and act only when the odds are favorable begin to notice something interesting in their results. In most traders simply never develop the patience to see it through. Price. Action tells usually don't. That lesson took me time and money to learn, and it takes most traders the same. Everyone arrives in the market with ideas, forecasts, and strong convictions. They read headlines. They listen to experts. They build stories about where a stock should go. But the market has a habit of ignoring even the most confident opinions. Have you ever been absolutely certain about a move, only to watch price do the exact opposite? The tape rarely lies, but people often do, especially to themselves. Price action is the purest expression of supply and demand. It reflects what money is actually doing, not what people are saying. Every tick on the chart represents real decisions made by buyers and sellers putting capital at risk. That is far more meaningful than any prediction or commentary floating around the market. When you learn to focus on price behavior, you begin to cut through the noise that traps so many traders. The difficulty is that opinions feel comfortable. They give the illusion of control. A trader forms a view and begins to look for evidence that supports it. He reads only the analysis that agrees with him. He ignores warning signs on the chart. Slowly, without realizing it, he stops observing and starts defending. That is a dangerous shift, Because once a trader becomes emotionally attached to an opinion, flexibility disappears. Have you noticed how hard it is to exit a trade when you are still convinced your original idea is correct? This is why professionals train themselves to watch what the market is doing, not what they think it should do. Higher highs and higher lows tell a clear story. Lower highs and lower lows tell another. Consolidations, breakouts, failed moves. These are the market's language. They are objective. They are visible. They do not depend on personal belief. Of course, this does not mean you abandon analysis altogether. Good traders prepare scenarios. They form hypotheses. But they always wait for price to confirm or deny those ideas. The chart gets the final vote. Not the news. Not the rumor. Not the feeling in your gut. One of the most expensive habits a trader can develop is arguing with price. The market begins to trend upward, and he keeps looking for reasons it must fall. Or the market weakens, and he insists the bottom is already in.